Jumia for many years has been a big retail favorite. They are a marketplace in many African countries, and they also are starting their own payment provider, mostly currently for their own website though. Now, the stock has not performed well because Jumia has very much underperformed, but over the last few months it has shot up massively. Now, let's look deeper into this. First of all, we gotta make sure we know what the company does. They operate in many African markets. However, they don't operate over all of Africa, but they offer in the biggest African economies except South Africa. In 2024, they had a GMV of 720 million, 170 million of revenue. That is a fairly high take rate there. And the story was basically Africa is still poor. As the countries develop, so will Jumia, if they are the ones to establish themselves as the African provider for all services. However, that story has kind of faltered on two things. One, as you can see, over the last few years, many of the big economies have had massive difficulties. So that was one big reason why the Jumia story failed so far. Because while they are slowly building out the logistics network, what does it help you if the underlying economies do not grow? For e-commerce to be massively profitable, you have to have giant operations. And if Jumia can't achieve revenue growth because of the underlying economies, then it doesn't matter how great your logistics are. And as you can see, revenue growth has not been stellar at all. Sure, it started off strong, but it came crashing down massively, and overall, these are not very high growth rates. Sure, they had their 20 to 30%, but overall, the revenue has barely moved since 2015, and they've been constantly burning cash. Now it has recently narrowed. This is one of the reasons why the stock shot up so much, and they just had high revenue growth again. So what happened? Revenue went up 25%, but at the same time, GMV only went up 6%. And when we look at where this revenue growth came from, we can see third-party sales, not a lot of growth, sure, some growth, but not exceptionally. This is basically other people selling on their platform, which was the whole thesis of this company. Value-added services, something they add on top there. Sure, slow growth, marketing and advertising, so the ads they run on their business perform very bad. However, first-party sales. They had a lot of corporations, big brands like Adidas, Starlink, to sell directly via Jumia. Now, the issue is, this is not very high margin revenue growth because it's them directly selling this. We can see this from the gross profit. While sure, it grew, it didn't grow in line with the revenue because this is a lower margin business. The marketplace barely grew. First party sales was the only thing that grew. And even with this giant explosion, they still burned $16.5 million. And it's not like they're sitting on a huge amount of cash. They're sitting on $85 million net cash. This is why this company is constantly diluting you. The whole story behind the company is that you have a leader all across Africa. They are gonna do the expensive task of building up logistics, investing a lot of money, but then they will be the only leader in the space. So if people wanna sell in Africa, which would be the big economy, they would have to go over Jumia, would have to pay them a lot of money. That was the story. Now it's being changed to Jumia taking on a lot of a risk, and additionally on building up logistics, also selling the stuff directly, and even if they're taking on risk, you're not profitable. Are they ever gonna be able to be the leading company? Because they might have been the African e-commerce player some time ago, but it has changed. See, Africa is a very complicated market, especially sub-Saharan. The amount of red tape between and in these countries is gigantic. Now, of course, Algeria, Egypt, Morocco, those are still easier businesses to be in. But Senegal, Cote d'Ivoire, Ghana, Nigeria, Kenya, Uganda, those are all very different markets with a lot of red tape, and the issue is that costs a lot of money to operate in. Now, they have managed to massively cut expenses after they notice they're not gonna have giant growth, but even with this expenses cut, they're still burning cash, despite being mostly the leader in these countries. At the same time, their competitors in Africa are usually taking the approach of operating in one country and maybe serving the surrounding countries. For example, Takealot in South Africa, not a direct competitor right now, but this is usually the playground. Takealot operates only in South Africa. Now, they're also not growing massively at 15%, but the issue is they're focusing on specific countries. They have big backers usually, for example, Naspa here, or in Nigeria, Konga, which has Zynex behind it. They're also only focusing on Nigeria, basically. So Jumia's approach of being all over Africa at the same time is currently not working and will probably not work, because they don't have a giant amount of cash they need to anymore. The local competition has established themselves with big backers, and despite giant cuts in operating expenses and approaching many different brands for big partnerships, they're still burning cash. Now, even if the African economies turn around and Jumia returns to growth, I don't think they're ever gonna become that bigly profitable. And Jumia is not big right now. They make 164 million in revenue. South Africa's Takealot makes 872 million. Some of the other competitors like Konga do not have public numbers, but estimates are saying that they're probably bigger than that. So I just don't see how Jumia is gonna scale across all of these different markets. Because if Jumia takes much longer, probably Amazon's gonna join into the frenzy, and now even the Chinese vendors directly are entering Africa. In if I'm a foreign firm wanting to sell in Africa, why would I go via an African company with a lot of struggles right now, which I've not worked with before, build up my relationship to sell there, when instead I could go with Temu? Pinduoduo, we worked with them before, we know how they work. Why would I go with a struggling company that kinda does everything at the same time, but nothing very well? Now, the only thing that can save Jumia is something like Axion buying them. But then it's a gamble on an acquisition. And at this time, do you really want to gamble on an acquisition that could fall through in any time? Especially if you operate over so many markets in Africa with a lot of red tape? That's a very difficult assumption. Now, I don't think the company's at risk of going bankrupt. They still can issue shares even at shit prices. And they still have 85 million. They lowered their cash burn. They can probably sustain themselves over the next few years. But the company doesn't have the same playroom that they had before the pandemic anymore. And they're not even investing so much anymore. Now, not all of their logistic investment is over capex. It's also a lot of local partnerships. But still, how do they want to continue to grow? I just don't see any way how Jumia can escape the cycle of competition across all their markets while not having a lot of backing. So in my mind, Jumia is an entire play on an acquisition. You can't really value this company at the moment. Because if they succeed, if they grow 20% over the next few years, become profitable, then this is a 10x, 20x something. But at the moment, I just don't see how you can do that. This would be a gamble on an acquisition, and I don't really see where this acquisition would be. I'm not going to invest in the stock. It's maybe an interesting case study, but not a good investment for me. What do you think? Write down below. Have a good day.